This is Nightly Business Report with Bill Griffith and Sue Herrera.
King dollar. The president accuses China and the European Union of manipulating their currencies, and the market responds. Power outage. General Electric's turnaround strategy hits a familiar snag, and profits drop by 30%. Canceled contracts. Why North Dakota's big soybean business may be struggling to survive. Those stories and much more tonight on Nightly Business Report for this Friday, July the 20th. And we bid you good evening, everybody. Sue is off one more time tonight. The market, as you know, has been focused on trade for some time now, but today that focus shifted to currencies, specifically the dollar, which fell during today's trade. And the reason for that decline was partly due to comments from President Trump during a CNBC interview, some of which we aired last night.
In China, their currency is dropping like a rock, and our currency is going up. And I have to tell you, it puts us at a disadvantage.
Then came a tweet in which the president wrote, China, the European Union, and others have been manipulating their currencies and interest rates lower while the U.S. is raising rates while the dollar gets stronger and stronger with each passing day, taking away our big competitive edge. As usual, not a level playing field. Now, those comments have been rattling the global markets, with some concern that a trade fight could turn into an all-out currency war. Even though it's too soon to tell what others might do, if anything, as far as nations go, we asked Sarah Eisen to explain how a currency war could potentially impact investors.
A currency war has competing nations purposely devaluing their currency to gain an international trade advantage. They do it by using monetary policy. How does a weaker currency create a trade advantage? As a country's exchange rate falls, the relative price of goods it exports also fall, increasing their demand abroad. And that increase in exports can boost the country's economy. There are many ways a country's central bank can devalue its currency, including lowering interest rates and printing money. That's how you win a currency war. But there are potential risks with devaluation. Instability in the value of a currency can discourage investment. Policies like printing money can cause future inflation. And currency wars create economic tension, which can lead competing nations to punish each other with trade tariffs. They can also increase market swings and uncertainty because ultimately it all rests on the whims of central bankers and policymakers. These moves can be dramatic, unpredictable, and dangerous. For Nightly Business Report, I'm Sarah Eisen.
Now, some prominent investors see currency swings as a big risk to the market. It's a concern that was echoed this week at CNBC's Delivering Alpha conference.
The risk we haven't talked about on the asset management side and where you deploy assets is currencies. And I would say that's probably one of the things that weighs heaviest on our mind are these currency moves, and they're becoming more pronounced and violent.
We're joined now by Eric Gordon. He'll talk about why it's so important for investors to keep an eye on the dollar. Of course, he's professor at the University of Michigan's Ross School of Business. Welcome back. Always, and nice to have you in the studio with us tonight here.
Thank you, Bill.
For investors, and I want to focus for investors on the currency issue that's going on right now, how much should they take into consideration currency swings when they make their investments?
Yeah, it's become important, and it's become more important because it isn't just about the trade balance. That trade balance flows through to the companies. If the dollar is lower, people buy more of our goods. Our companies do better. If you're an investor, you would like to be in those companies.
Typically, people will say, stay away from multinationals, those that do a lot of business overseas, when the dollar is strong, for example, because our goods are more expensive that way. Is it that simple?
Well, it's never quite that simple, because when the dollar is strong, although our multinational companies do worse and you probably don't want to be in their stock, the strong dollar attracts money from overseas that goes into our stocks, and that causes more demand. So, it's a ticklish thing with a force going one direction and a force going the other direction.
And then interest rates are going up, and, it's a very complicated situation. But you bring up an interesting point that most people don't talk about. as far as currency wars go, currency fluctuations, I should say, and investing. You're looking at exchange-traded funds. What role do they play?
Yeah, so a lot of us have our pension money or other money in ETFs and index funds. So we think we're not participants in the war. It turns out we are participants in the war because these index funds contain, well, lots and lots of companies. And over the last 10 or 20 years, lots more of those companies do lots more of their business abroad. So, we tend to think, well, I'm not involved in this multinational stuff. It turns out that my retirement is involved. And
if that's the case, how do you try and hedge? I mean, the big investors, they will hedge their currency risk. What can a little guy do? It's hard for somebody like me and the typical individual investor to hedge. But if the currency war disfavors multinationals, then you invest in companies that do most of the business domestically. Hospital chains don't have hospitals in other countries. Right. But if there is a competitive devaluation and our currency goes down, then being in those multinationals is a very good idea. Very good. Eric, always good to see you. Thank you. My pleasure. Enjoy your time in New York City. Thank you. Eric Gordon with the University of Michigan's Ross School of Business joining us tonight. On Wall Street, the Dow was able to post its first 3-week win streak since January, even though it did close slightly lower today. The industrial average lost 6 points, closed at 25,058. The NASDAQ was down 5. The S&P fell by 2. And for the week, the Dow and the S&P were higher, while the NASDAQ was slightly lower. A familiar problem continued to hang over General Electric during the most recent quarter. That would be its power unit. Weakness there forced the former Dow component to cut a financial target, and shares fell 4% in trading today as a result, despite reporting better than expected earnings and revenue overall. Morgan Brennan has more now on GE's results.
Powering through the pain. That was the message from General Electric today when it reported a 30% drop in profit. Weakness in the hard-hit power division continued to offset growth in GE's other major units, especially healthcare and aviation. On a call with analysts, CEO John Flannery said the struggling company has made significant progress in what he describes as a reset year.
We expect the second half to be better than the first half. GE is on a multi-year transformational journey, and the path forward is clear. Overall, we feel good about our execution. We see strength across the majority of the portfolio. We remain focused on implementing the broad macro strategic changes we outlined in June, while making sure our micro execution in each business continues to improve across the company.
While GE stuck with its 2018 profit goal, it did say free cash flow from its industrial businesses would be about $6 billion, or the low end of previous guidance. Even so, the stock fell, as some analysts feared it's a financial bar that may still be too high to hurdle. But GE is in flux. It recently unveiled a roadmap to restructure, spinning off healthcare into a standalone company and exiting its majority stake in Baker Hughes. Moves that have been, so far, welcomed by Wall Street.
Flannery was handed a very difficult hand, and I think he's doing a good job. He knows he can create value by spinning medical and oil and gas, and that will work. His difficulty is going to be digging out of the hole thereafter with still a big pension underfunding, and again, about 50% of the industrial revenues in power, which is a division that's going to struggle to generate organic growth.
GE's pension shortfall is nearly $30 billion, the largest in the S&P 500. The other big topic today, though, tariffs, given GE's global footprint. To that, Flannery said GE is a company built for fair and open trade. But if, over time, it's necessary, it could always shift its supply chain to counter trade winds. For Nightly Business Report, I'm Morgan Brennan at the New York Stock Exchange.
And it's time to take a look now at some of today's upgrades and downgrades. We begin with Microsoft. Their price target was lifted to $118 a share from Stifel Nicolaus following the company's earnings that we told you about yesterday. The analyst cited momentum across Microsoft's cloud and gaming units, and the rating remains a buy as a result. The stock rose more than 1.5% today to 106.27. Six Flags was downgraded to neutral from outperform at Wedbush. The analysts there cited headwinds facing the firm, including weather and a high stock valuation. Price target $70. The stock fell more than 4% today to $67.64. Skechers was also downgraded to neutral from positive at Susquehanna. The firm cites a negative outlook following the company's very disappointing earnings report of yesterday. Price target $26. Shares dropped by 21% today to $26.27. Still ahead, soybeans get squeezed.
I'm Contessa Brewer in Portland, North Dakota, where farmers are feeling the pinch from this U.S.-China trade war. 25% tariffs slapped on their soybeans just when they're coming into a bountiful harvest. I have more ahead on Nightly Business Report.
Now to trade, where the president said that he is ready to go with tariffs on all $500 billion worth of Chinese goods that come into this country. He made those comments in an interview with CNBC's Joe Kernan.
We're down a tremendous amount. I raised 50, and they matched us. I said, you don't match us. You can't match us, because otherwise we're always going to be behind the eight ball.
Would you ever get to 500, though?
I'm ready to go to 500.
And it was that phrase, ready to go, that grabbed investor attention. As you know, the Trump administration has so far imposed tariffs on $34 billion worth of Chinese products, which was then matched by Beijing. And the White House then threatened to impose another round of tariffs on $200 billion worth of Chinese imports. One industry caught in the middle of this trade war between the United States and China is the soybean business. It has American farmers scrambling to find new markets. Contessa Brewer is in Portland, North Dakota for us tonight.
In North Dakota, where county roads aren't paved and where neighbors live far apart, soybeans are big business.
It's a better opportunity with these food-grade soybeans. There's a little better market for it, and it's expanding worldwide.
In fact, soybean production in this state has grown exponentially since 2000, exporting more than 70% to other countries. And the number one consumer, China, which buys as much as $35 million worth of North Dakota soybeans every year. But this year, China's slapped a 25% tariff on American soybeans.
A lot of producers might not survive this.
As processors head to August, when contracts are typically locked down with foreign buyers, across North Dakota, all the firm China soybean contracts have been canceled. Chinese trade groups that were scheduled to visit have either pulled out or stopped communicating.
It's just not China. It seemed like we simultaneously picked a fight with everyone.
At grain processor Richland IFC, 23% of the food-grade soybean exports are sent to China. President Rick Brandenberger's been investing millions to expand his facilities and his Chinese customer base. But the new trade war is threatening those plans, with contracts canceled immediately when the retaliatory tariffs went into effect.
We actually redirected shipments that were en route to China to other countries, to alternative markets at that time.
But lost $40,000 in the process. North Dakota's trade office is scrambling for other buyers for what looks like a bountiful harvest.
It's pretty difficult to really move overnight and try to find a brand new customer. You know, these are relationships that are built up over years and years and multiple visits and meetings. And just to pick up and move and find somebody else, it's going to be pretty difficult.
Most farmers here can't afford a lengthy trade war. Soybean prices have been low, but in the 3 months or so since China started talking tough about tariffs, they've plummeted almost 20%. Now they stand at $8.50 per bushel. And to break even, farmers need at least $9.
We don't want to be in business to break even, but this year alone, I think if the prices stay where they are, a lot of people could really suffer.
While Washington takes a long view of global trade issues, here, farmers worry how long they can sustain their amber waves of grain. In Portland, North Dakota, Contessa Brewer, Nightly Business Report.
Now, China is also a huge growth market for Starbucks. The company recently said that it plans to open a new store every 15 hours over the next 4 years. But it also faces new competition, in this case from a Chinese startup. Eunice Yoon is in Beijing for us tonight.
I'm at Starbucks' newest competitor in China. The chain is called Luck In. The name comes from the Chinese Rei Xin, or luck and happiness. The logo is of a deer that's native to China, and that's really what makes this company and the Starbucks rival different from the others, because it's totally homegrown. I spoke to one of the co-founders, Eric Guo, who told me Luck In is different from Starbucks because it's betting that Chinese will be doing everything with their mobile phones, so you can only pay through the app, no cash. And many of their stores double as delivery stations, since more Chinese like to order food and drinks online. You get your coffee within 30 minutes, or it's free.
The old way is people looking for coffee. With us, coffee finds them.
Like other Chinese rivals to foreign companies, Luck In competes on price. Its drinks are about 20 to 30% cheaper than Starbucks. It's also openly criticizing Starbucks. Luck In recently wrote an open letter about what it described as Starbucks' monopolistic practices, and Guo said Luck In is suing.
We believe Starbucks' behavior undermines fair competition and prevents Chinese customers from having convenient access to high-quality coffee at a reasonable price.
As for the trade war, Guo said that he doesn't believe that Luck In will benefit because it's a Chinese brand. But just this week, the state media interviewed customers here who said that they prefer Luck In to Starbucks because of the trade war. For Nightly Business Reports, I'm Eunice Yoon in Beijing.
Honeywell raises its full-year profit outlook for the third time. That's where we begin tonight's market focus. The aerospace and defense company revised its 2018 guidance after it said stronger demand for aircraft parts led to an overall earnings beat in the quarter. As for that tariff impact, Honeywell said that it has started sourcing components from other countries other than China, and it has raised prices on some of its products as well. Honeywell up nearly 4% today to $153.13. A rise in sales led to stronger than expected earnings at Stanley Black & Decker. That company did cut its profit outlook for the year, but said that that's largely due to the costs tied to a settlement to clean up toxic contamination at a Superfund site. Shares rose 3% today to $144.23. VF Corp said that it expects profits and revenue to accelerate this year thanks to rising demand for its Vans sneakers. The parent company of brands like North Face and Wrangler jeans reported higher quarterly revenue as e-commerce and international sales also grew. VF up 4% on the day at $92.94. And financial services company State Street said that it is buying privately held analytics software firm Charles River Systems for nearly $3 billion. State Street will now have access to a service platform that gives clients greater flexibility. State Street said that more value and efficiencies will also arise from this transaction.
We're simplifying their own operation, lowering their costs, and most importantly, giving them access to data in a way that they can inject it back into their own investment process. So it's a highly flexible system that utilizes either our capabilities or the capabilities of others, but in a seamless way.
The company did say, though, that it would have to suspend its $950 million share buyback to fund this deal. Shares fell by 7% today to $85.87. The Financial Times is reporting that drug maker GlaxoSmithKline's chairman is considering splitting up that company. Philip Hampton is said to have spoken with the company's largest shareholders, talking about creating a pharma and vaccine division, which would be separate from its consumer health business. Glaxo rose nearly 3% today to $41.87. This week's Market Monitor is digging for value. Not an easy task in a growth market. The last time he was with us was in August of last year, and he picked Shire, which since then is up 16%, Amerco, that's added 4% since then, and NCR, which has declined by 13%. Back with us, Richard Steinberg. He's President, Chief Investment Officer of Steinberg Global Asset Management. Rich, always good to see you. Thanks for joining us.
Always good to see you, Bill.
2 out of 3, I guess, is not bad. Do you still like NCR?
We own all three. Yeah, NCR, I think, will start to come along as the financials start to pick up. And, you know, when you buy these value stocks, you have to look out 3 years on them.
You are a classic value investor, and I always ask you, when we're in the midst of a market like this where we sit near all-time highs, is it tougher to find value right now?
Yeah, we've been digging deep. Our analysts are scrubbing not only numbers, but also conference calls to see what names are just kind of out of favor, but not broken. And that's why we have 3 new names today that fall into that special situations category.
First up, NovoCure in cancer
It's
treatment.
it's a really interesting oncology play. They have a technology called tumor treating fields. The device is called Optune. It looks almost like a sci-fi cap that goes on the patient's head. And with chemo, the science has been excellent. We think the stock is worth $54 or 40% higher here. And if the FDA gives them approval down the road for other tumors, either below the neck or brain tumors, there could be even more upside to that name.
And yes, I was going to say that has had a good ride this year, especially the last couple of years, as a matter of fact. Here's now Yelp. Now here's one that has suffered, and you have to, again, you're trying to find one that has value that's not broken.
Yeah, this is not a FANG name. It's busted, but certainly not broken. The stock, connects consumers with companies. It's an ad play. Many people have seen the Yelp reviews either on their iPhones or online. It's really also a millennial play because millennials won't make any decisions without looking at an app. The stock has no debt, trades at 24 times cash flow, and we think it's worth $64. A lot of upside to this. Also, they've been growing their earnings at 43% per year over the last 5 years, and we think it's cheap. It could also be an acquisition candidate down the road if somebody wants to be in the space.
Finally, American Tower. So many people pick this one in the value space. It's a real estate investment trust. I'm surprised it doesn't yield more than it does. It's only 2.19%. I guess that's a function of its stock performance as well, huh?
It's also a growth REIT, yeah, and they're constantly reinvesting. They have 160,000 sites throughout the world, 44% of their businesses outside. But we like this because it's an oligopoly. You have American Tower, you have SBA Communications, and you have Crown Castle. And they're the 800-pound gorilla. The stock trades at under 18 times free cash flow. The stock's been beaten up because of some issues in consolidation in India. But we think the stock's really interesting at these levels. We have a $180 price target, which is 30% from here. And I think it's a name you can put away for 3 years.
All right. Rich, always good to see you. Enjoy the rest of your summer.
Take care. Bye, Bill.
Richard Steinberg with Steinberg Global Asset Management joining us. And to read more about his picks, you can head to our website at nbr.com. Coming up, FanDuel's big wager on the future of sports betting. Right now, consumers are paying more than $100 billion in credit card interest and fees. That's according to new research that says that 10% more than a year ago and about 40% more than we were paying in 2013. Part of the reason is because interest rates are ticking higher and total credit card debt stands at more than $1 trillion right now. Sports betting is changing. A recent Supreme Court ruling has ushered in a new era for gamblers placing wagers on their favorite teams. And as Eric Chemi reports for us now, FanDuel wants to make sure it's leading the charge.
It's been just a few weeks since the Supreme Court opened the door for legalized sports betting, with New Jersey among the states leading the way. The newest legal sportsbook is now open at Meadowlands Park, located just a couple miles from Manhattan and home to the NFL's Giants and Jets. It will be run by FanDuel, who's hoping to cash in with their first brick-and-mortar location.
It's a great way to build our brand and continue our ongoing effort to become an inextricable kind of part of people's sporting experience. And so particularly given the Meadowlands location right next to Jets and Giants Stadium, you can't get closer to sports than that.
Through FanDuel's recent merger with European operator Paddy Power Betfair, they plan on being involved in every part of the action, with plans to launch an online sports betting and internet casino just ahead of NFL season.
We really created a business that has several lines of business. One is the FanDuel fantasy business. Two is the FanDuel Sportsbook. 3 is the online casino business, which is the second largest in New Jersey. And then the 4th is TVG, which is the largest online horse wagering business. And so across those 4 businesses, we are the largest online gaming operator in the U.S. today.
Morgan Stanley expects by 2025 there could be $5 billion in sports gambling revenue nationwide. But it also sees a wide range, anywhere from $1 billion in the bear case to $11 billion in the bull case. It all depends on how many states legalize sports gambling and what kind of rules they put in place.
We've largely tackled the challenges of operating different game types in different states and dealing with different eligibility requirements. And so we don't look at it to be that much of a challenge to operate in various states. It just means that you need to make sure you have great relationships with all the various regulators and have a flexible technology solution, which we have both of.
Industry analysts expect to see more mergers like the one between FanDuel and Paddy Power Betfair, combining a domestic company with a large list of customers along with a proven gambling operator.
We think that we have a great advantage. We exist in the leadership position today as being the largest online gaming operator in the U.S. We have the largest database of KYC'd users, so users that have actually been verified that they can bet. We have a brand that people trust and associate with real money gaming, and we think that we have great product. And so across those things, we think that that's a huge advantage that we'll be able to parlay into a continued leadership position as the market goes through what we think will be a hyper-growth period.
By the time this NFL season kicks off in September, expect to see a lot more action on the sidelines and in the audience. For Nightly Business Report, I'm Eric Chemi.
And that is NBR for tonight. Again, as always, we thank you for watching. Have a wonderful weekend. We'll see you on Monday.